All right, let's dive right into this. We are looking at one of the most fascinating and honestly counterintuitive economic situations in the modern aviation industry right now. Welcome to this explainer on Frontier Airlines and their wildly unpredictable 2026 comeback. Normally, in the ultra low cost carrier space, or ULCC for short, there's a golden rule. If you want to fly more passengers, you have to cut your ticket prices. But Frontier, they're doing the exact opposite. They are raising prices while flying more passengers than ever before. It's a complete paradox, and it's sending shockwaves through the market. So today, we're going to unpack exactly how they're pulling this off. And, more importantly, if they can actually survive the turbulence ahead.
Here's our roadmap for today. First, the revenue paradox. Second, the Spirit vacuum. Third, the cost conundrum. Fourth, the new ULC model. And finally, the ultimate profitability test. Starting off with Section 1, the revenue paradox, defying airline economics. Let's get right into the recent logic-defying financial metrics that have literally everyone talking. $1.3 billion. That is Frontier's staggering, record-breaking second quarter revenue. Just to put that in perspective, that's a massive 38% increase year over year. And as management pointed out, this wasn't simply a byproduct of inflation. This incredible influx of cash reflected extremely strong travel demand and a ruthless execution of their new commercial strategy. But the real standout here is a massive 28% jump in a crucial airline metric called RASM, which stands for Revenue Per Available Seat Mile. Frontier's RASM surged by approximately 28%, up to 11.52 cents. But here's the kicker. Their overall capacity only increased by 8%. Think about what that means. Frontier wasn't just dumping more planes and seats into the market to get that revenue. They were actually extracting significantly more money out of every single available seat they were already flying. And this completes the ultimate paradox. 14%. Passenger volume grew by 14%, even as the fare revenue they collected per passenger skyrocketed by 54%. So the crucial takeaway here is that they're defying gravity. Normally, you have to drop fares to fill 14% more seats, but because of a profound structural change in the market, Frontier proved you can actually hike fares by over 50% and still pack the planes. How? Well, let's look at the catalyst.
That brings us to Section 2, the Spirit vacuum. Less competition, more power.
This vacuum is the real structural reason behind Frontier's sudden, incredible pricing power. And their capitalization on this wasn't just a one-off event. It was a relentless, year-long domino effect of aggressive expansion. It started back in December 2025 when they announced 23 new routes across 24 airports. By June 2026, they announced a strategic return to Oakland. By July, they had officially taken over 8 routes previously operated by their collapsed rival Spirit Airlines. And culminating in August, they launched an Oakland to Las Vegas route flying a whopping 11 times a week. Vegas is the ultimate price-sensitive leisure destination, and Frontier is moving in to completely dominate it.
This quote sums it up perfectly. Spirit's exit reduced the number of ultra-low-cost seats competing for customers, and Frontier suddenly had more pricing power. Almost overnight, the competitive landscape was shattered, but Frontier didn't just sit back. They immediately swooped in. They offered discounted rescue fares to stranded Spirit passengers, and they pushed a $199 Go Wild summer pass to absorb that abandoned customer base. They aren't just growing organically, they are growing into a completely wide-open market. Which leads us to Section 3, the cost conundrum, the reality check. Because, as amazing as those revenue numbers are, there's always a catch in the airline industry. Negative $22 million. Just let that sink in for a second. Despite producing a record-shattering $1.3 billion in revenue, Frontier still reported an adjusted net loss of approximately $22 million for the second quarter. This is the harsh, unforgiving reality of airline economics. Revenue growth and pricing power are fantastic, for sure, but airlines are burdened with heavy, unavoidable costs. We're talking aircraft financing, labor, maintenance, airport fees, and of course, the absolute biggest villain in our story, fuel. Back in Q2, fuel was sitting at an agonizing $4.17 per gallon. That resulted in a staggering $436 million expense for Frontier in a single quarter, nearly doubling year over year. It's a brutal cycle. If fuel costs rise, ticket prices have to rise, and if ticket prices rise too much, those budget-conscious customers disappear. Now, the good news here is that management does expect some relief, forecasting fuel to drop to $3.70 in Q3 and down to $3.50 in Q4. But as we all know, oil markets are incredibly volatile. So,
How are they adapting? That's Section 4, the new ULCC model, beyond the bare bones.
To survive these brutal costs, Frontier realizes they can't just be the cheapest ticket in town anymore. They're building a completely new way to monetize a single passenger. It's really a stacked approach. Step 1 remains the classic hook, low base fares. But then comes Step 2, charging for bags and seat selection. Step 3 introduces priority services. And then Step 4, which is the real shocker for an ultra-low-cost carrier, premium upgrades. Frontier is actually introducing first-class seats and planning to roll out Starlink high-speed internet. They're trying to change the very perception of what a budget airline can offer, literally layering a premium experience right on top of a rock-bottom ticket price. This whole strategy revolves entirely around ancillary revenue. Basically, this is the non-ticket revenue generated by those optional services and upgrades that significantly boost profit margins. Balancing a super low initial fare with high-value, high-margin add-ons isn't just a neat trick for them. It's Frontier's absolute lifeline to survival. If they stay too cheap, they can't cover that $436 million fuel bill. If they get too expensive up front, they lose their core customer. Ancillary revenue is the tightrope they have to walk every single day.
Finally, Section 5, the ultimate profitability test, Q3 and beyond.
Because at the end of the day, investors don't just want to see full planes, right? They want to see actual profits. So we arrive at a very delicate, dangerous balance. On one side, we have the bull case. Frontier maintains disciplined capacity, successfully absorbs those orphan Spirit customers, normalizes their fuel costs, and transitions from just revenue growth into actual earnings growth. But right across from it is the terrifying bear case. Frontier gets too aggressive, they overexpand their network, competitors respond by flooding the market with seats, fare wars begin, fuel spikes, and margins are completely destroyed. As we've seen, more flights do not always equal more profits. But management is actually striking a very optimistic tone for the third quarter. They're forecasting their earnings per share to land somewhere between a 10-cent loss and a 10-cent profit. This is huge, mainly because Wall Street analysts were bracing for a much more severe 29-cent loss. Furthermore, Frontier expects that critical RASM metric to rise another 20% year over year. If they hit these numbers, it proves Q2 wasn't just a fluke. It provides hard evidence of a genuine, sustainable earnings turnaround.
So as we watch this whole story unfold, try not to get distracted by the daily noise of their stock, which was recently hovering around $5.96. A 3% daily bump really doesn't tell the whole story. Instead, keep these 3 fundamental metrics in mind as a sort of cheat sheet. Monitor RASM growth, which was up 28%, passenger growth, up 14%, and fuel expense, which was draining $436 million. These are the vital signs that will actually tell you if this airline is healthy.
Which leaves us with the ultimate question. Can Frontier turn this unprecedented, once-in-a-generation pricing power into durable, sustainable earnings before the inevitable next capacity cycle comes around to crush their margins? They are attempting perhaps the most difficult business turnaround in modern aviation. I mean, they have the passengers, they have the routes, and they have the revenue. Now, they just have to prove they can make a profit. Keep your eyes on those Q3 earnings because the skies ahead are anything but predictable. Thanks for joining me on this explainer, and keep learning.